Tuesday morning, January 13th, 2026. And while you were scrolling through whatever corporate media decided to feed you this morning, something extraordinary happened in the precious metals market that almost nobody is talking about. 24 hours ago at 10:30 a.m. Eastern, I pulled up my usual market snapshot, and the numbers made me sit up in my chair. Silver had just moved 7% in a session. Not over a week, not over a month. In one session. But here's what made my stomach drop. When I checked the physical dealers, the actual places where you and I can buy real metal, American Silver Eagles were trading north of $100. Not 85, 100. I've been trading and stacking physical silver for over a decade now, with direct access to institutional data feeds that most retail investors never see. I started this channel because I was tired of watching AI avatar channels pump out garbage information while real stackers were left in the dark, sometimes 12 to 24 hours behind what the institutional players already knew. So I use this format purely for speed to get you the intel while it still matters. Bloomberg is calling this a speculative froth event. CNBC ran a segment about supply chain disruptions and temporary dislocations. The mainstream financial press is doing what they always do, telling you to look at the ticker, to trust the screen, to believe that the number flashing in front of you represents reality. But I'm not here to show you the ticker. I'm here to show you the vault, because while the screen says $85, the street, the actual physical market where metal changes hands, is saying 100. The real story isn't a price spike, it's a system failure. And that's not even the most dangerous part. The most dangerous part is what this tells us about the US dollar, about the COMEX futures exchange, and about why one of the world's biggest banks might be preparing to wage economic warfare against precious metals holders in the next 72 hours. Here's my primary claim, and I need you to understand this clearly. The physical silver market has entered what I call a liquidity black hole. We are no longer in a bull market. We are not in a supply squeeze. We are in a decoupling event, a moment where the paper price of silver, the number you see on your brokerage app or on Yahoo Finance, has become a ghost, a fiction, a number that exists on screens but has almost no relationship to what it costs to actually hold the metal in your hand. The breach of $100 for a single American Silver Eagle is the ultimate signal that the US dollar's bluff has been called. When the most recognizable, most liquid silver coin on the planet is trading 15% above the so-called spot price, that's not a premium. That's a scarcity tax. That's the market screaming that something is fundamentally broken. I'm going to break down the exact mechanics of what I call physical premium decoupling. I'm going to run the math on why the COMEX is losing its grip on price discovery. And I'm going to share my personal battle plan, not advice, but exactly how I'm positioning my own capital as the exit door for the dollar begins to shrink. I'm not here to tell you what to buy. I'm here to show you exactly what I'm doing, what I'm watching, and why the next 72 hours could determine whether you're holding real wealth or just paper promises. Because if my math is right, the paper price of silver is about to become completely irrelevant. Let me give you the exact snapshot from yesterday morning. At 10:30 a.m. Eastern on January 12th, spot silver was trading at $85.61 per ounce. That's a 7.09% move in a single session. Gold was at $4,611.12. These are parabolic numbers. The kind of vertical price action that makes seasoned traders nervous because it signals that something has fundamentally changed in the supply-demand dynamic. But here's where it gets interesting. I immediately went to the big three physical dealers, APMEX, JM Bullion, and SD Bullion. These are the main pipelines for retail silver in North America. And what I found was a market that had completely detached from the paper price. American Silver Eagles, the standard 1-ounce coin that every stacker recognizes, were officially listed at over $100. Not 90, not 95, 100 plus. Earlier that morning, around 7:30 a.m., JM Bullion's inventory page for 90% junk silver, the old pre-1965 dimes and quarters that stackers love because they carry lower premiums, showed a simple message: sold out, not temporarily out of stock, not ships in 2 weeks, sold out. APMEX, usually the most aggressive on inventory, had raised their premium on 90% silver to $4 per ounce over spot. That's not a fee, that's a scarcity tax. That's a dealer saying, we have metal, but we know what's coming and we're not letting it go cheap. So let me spell out the screen lie that's happening right now. The paper market, the COMEX futures exchange, where the so-called spot price is discovered, is telling you that silver is worth $85.61. But if you want to actually hold that silver, if you want to convert your dollars into physical metal that you can store in your safe or bury in your backyard, you're paying $100 or more. That's a 15% lie. A 15% gap between the fantasy price on the screen and the reality price on the street. The dealers aren't just raising prices because they're greedy, they're pulling inventory, they're slowing down sales, they're implementing purchase limits because They know something that the talking heads on CNBC don't want you to know. The COMEX vaults are running on fumes, and when the next delivery demand hits, someone is going to be holding an empty bag. Let me teach you the core mechanism that's driving this chaos. It's called physical premium decoupling. And if you understand this concept, you'll understand why the next few weeks could redefine the precious metals market for a generation. Here's the simple definition. Physical premium decoupling occurs when the total cost to own physical metal, spot price plus premium, moves independently and significantly higher than the futures contract price on the paper exchange. When that gap widens to 10, 15, 20% or more, it's a signal that the paper exchange has lost the ability to discover the true value of the asset. The exchange has gone dry. It's no longer setting the price. It's just setting a number that increasingly has no connection to physical reality. Think of it like this. Imagine you want to go to a concert. The box office, the official ticket seller, says tickets are $50. That's the spot price, but when you show up to the box office, it's boarded up, sold out. The only way into the show is through the scalper standing out front, and he's charging $150. Now, you might have a $50 ticket stub in your pocket, maybe an electronic receipt, maybe even a futures contract promising you a seat. But if the doors are locked and the only way in is through the scalper, do you really have a seat, or do you just have a piece of paper? This is exactly what's happening in the silver market right now. The COMEX, the box office, is still printing tickets and claiming the price is $85. But the doors to the physical vault are effectively locked for retail buyers. The only way to get metal is through the dealers, the scalpers, and they're charging $100 or more. If you're holding an SLV share, a silver ETF, or a futures contract, you have the equivalent of that $50 ticket stub. But can you actually get into the vault? Can you actually take delivery of your metal? The system is trapped. ETFs like SLV are supposed to hold physical silver to back their shares. But when the premiums on physical metal are 15 to 20% above the spot price, how do they acquire more inventory to meet redemptions? They can't, not without taking a massive loss. So they either suspend redemptions or they settle in cash, or they find some creative accounting to pretend the metal is there when it's not. This is the exact moment when paper promises start to break. But here's where it gets even darker. What happens when even the scalpers can't get tickets? What happens when the dealers themselves run out of metal to sell? That's when we enter what's called the force majeure phase, the moment when mints and refiners declare that they cannot fulfill their contracts because the underlying commodity simply doesn't exist in sufficient quantity. We're not there yet, but we're closer than we've ever been. Let me run the math for you, because I want you to see exactly what this means for anyone trying to preserve wealth in this environment. Conservative scenario. Let's say you buy 100 ounces of physical silver right now. If you're paying a $15 premium per ounce over the $85 spot price, you're starting out 15% underwater relative to the paper price. On the surface, that looks like a bad trade. You paid $100 per ounce, but the screen says it's only worth $85. So you're down $1,500 before the metal even ships. But here's the flip side. You have zero counterparty risk. You own the metal. It's in your possession. You're not trusting a bank, a vault service, an ETF manager, or a brokerage to hold your wealth. You've exited the system. And in a decoupling event, that 15% friction cost is the price of safety. It's the price of being outside the blast radius when the paper market collapses. Now let's stress test this. What happens if spot silver hits $90 this week? Historically, premiums widen during periods of high volatility and tight supply. A $90 spot price could easily push American Silver Eagles to $120 or more. So your 100 ounces, which you paid $10,000 for, are now being offered at $12,000 on the physical market. The value is not just tracking the paper price, it's accelerating away from the dollar faster than the ticker can keep up. Here's another angle that almost nobody is talking about, the dollar index illusion. Right now, the DXY, the index that measures the dollar's strength against a basket of other fiat currencies, might look relatively stable. It might even be climbing. But silver is exploding. How is that possible if the dollar is strong? Simple. The dollar isn't strong. The other fiat currencies, the euro, the yen, the pound, are just failing faster. It's a race to the bottom, and silver is the referee calling the bluff on all of them. Stop. I want you to look at what happened on January 12th. That vertical move, that 7% spike in a single session, that's what traders call a God candle. It's a price move so aggressive, so devoid of overhead resistance that it signals a total breakdown in the normal supply-demand equilibrium. There were no significant pullbacks, no consolidation, just a straight vertical line. That's not speculation. That's panic buying, meeting a brick wall of no supply. Here's what we know so far. The dealers are running on empty. The paper price is a fiction. The $100 Silver Eagle is the new floor, but the banks, the COMEX, The institutional players who have been shorting this market for years, they have one final weapon to try and kill this rally, and it starts with a margin call. I know what the skeptics are going to say. I can already hear it. This is a retail bull trap. This is 2011 all over again. The CME is going to hike margin requirements, force all the levered longs to liquidate, and crash the price back to $60. You're chasing a top, and you're going to get smoked. Let me steelman that argument because it's not completely wrong. In 2011, silver ran from $18 to nearly $50 in less than a year. And then the CME stepped in, hiked margin requirements multiple times in a single week, and the price collapsed back to $26 in a matter of days. It was brutal. Retail got destroyed. The leveraged speculators were wiped out. And the narrative became, see, silver is just a speculative bubble. It's not real money. It's a casino. But here's the difference. In 2011, COMEX inventories were high. The registered silver available for delivery was abundant. There was metal in the vaults. The price spike was driven by speculation, by leveraged futures contracts, by momentum traders who had no intention of ever taking physical delivery. When the margin hikes came, those traders had to sell. And there was enough physical supply to absorb the selling pressure and stabilize the market at a lower level. Today, we are in a 7-year structural deficit. Industrial demand for silver, solar panels, electric vehicles, 5G infrastructure, defense electronics, has been outpacing mine supply for years. Registered COMEX stocks are down 70% from their peak levels. The cupboards are bare. This isn't a speculative bubble. This is a supply crisis, meaning a loss of confidence in fiat currency. Here's the myth I want to destroy. The idea that higher prices will bring out more scrap supply. The theory is that when silver hits $85 or $100, people will start raiding their grandma's silverware drawer, melting down old jewelry and flooding the market with secondary supply. And that's true to some extent for consumer discretionary uses. But industrial demand is price inelastic. Tesla doesn't stop building cars because silver went from $25 to $85. Solar panel manufacturers don't shut down production lines because silver premiums are high. Defense contractors don't stop making radar systems and missile guidance electronics because the metal got expensive. They must have the silver, regardless of whether it's $80 or $180 per ounce. They'll pay whatever it costs because the alternative is shutting down their entire operation. So yes, the CME could hike margin requirements. They probably will. And yes, that could crash the paper price. You could see a wick down to $70 or even $65 on the futures exchange as the levered longs get flushed out. But here's what the skeptics don't understand. A margin hike might crash the ticker, but it will only make the physical premium move higher. Because every time the paper market gets manipulated, every time the COMEX pulls one of these stunts, more people wake up to the fact that the system is rigged. And they flee the paper. They demand physical delivery. They walk away from the ETFs and the futures contracts, and they go straight to the dealers. And that increases the pressure on an already depleted physical supply. They can crash the ticker, but they can't print the silver. And that brings me to the rumor that's circulating in some of the institutional channels I monitor. Let me be very clear. This is unverified. This is market rumor. But it's being discussed by people who usually have access to information before it hits the mainstream. The rumor is that JP Morgan, one of the largest silver short positions in the COMEX system, is pivoting to support aggressive Federal Reserve rate hikes, specifically to wage economic warfare against the new administration's gold and silver-friendly policy signals. The theory is that by crushing the broader economy with higher rates, they can trigger a deflationary panic-force liquidations in the commodity sector and drive the paper price of silver down to relieve the pressure on their short positions. Now, I have no idea if that's true. It could be complete nonsense, but the pattern fits. Every time precious metals start to run, every time the dollar's credibility comes into question, the institutional playbook is to tighten monetary policy, strengthen the dollar index artificially, and crush commodity prices. It worked in the 1980s. It worked in 2013. The question is, will it work now when the physical market is this tight? Here's another rumor that's harder to dismiss. Multiple secondary mints, the smaller refiners who produce silver rounds and bars, are preparing to declare force majeure. That's a legal term that means they cannot fulfill their contracts due to circumstances beyond their control. In this case, the circumstance is a lack of silver grain, the raw material they need to produce coins and bars. If the mints stop minting, if the refiners can't get feedstock, then the price of silver becomes a very simple question. How much do you have, and can I have it? At that point, the ticker is irrelevant. It's pure barter, pure negotiation. I'm also watching the vault movements. Silver is draining out of London and New York and moving east to the Shanghai Gold Exchange, where prices are already trading at a premium to Western markets. The metal is leaving the system that the COMEX controls and entering a system where the Chinese government, the Indian market, and Middle Eastern sovereign wealth funds have much stronger influence. Once that metal is gone, it's not coming back. The COMEX can print all the paper contracts it wants, but if the physical metal is on the other side of the world, those contracts are worthless. And here's what I am watching in the media: a wave of nothing to see here articles. Analysts explaining this away as a temporary squeeze, pundits saying that silver always spikes and then crashes, so don't get caught holding the bag. The same playbook they always run: keep the retail investor calm, keep them believing in the paper system, keep them from rushing to the exits all at once. But the vault drain continues. The premiums continue to widen. And the longer this goes on, the closer we get to the moment when the mints stop minting and the price of silver becomes whatever someone is willing to trade for it. So what am I doing? What's my personal battle plan? As this unfolds, let me walk you through my levels and my triggers, because this is how I'm thinking about the next 72 hours. First, I'm watching the $100 physical support level. If the spot price on the COMEX drops, let's say we get a margin hike and it crashes to $75, but American Silver Eagles are still trading at $100 or higher, then the decoupling is permanent. At that point, the paper price is completely disconnected from reality, and I know that physical is the only game in town. That would be the ultimate confirmation that the COMEX has lost. Second, I'm watching for a margin hike from the CME. If they announce a 20% or greater increase in margin requirements for silver futures, I'm expecting a violent paper sell-off, but I'm not panicking. I'm not selling my physical. In fact, I'm going to be looking at that as a buying opportunity, not in the futures market, but in the physical market at my local coin shop. I'll ignore the noise on the screen and focus on what's real. Third, here's my if-then framework. If spot silver clears $90 per ounce this week, I'm sitting on my hands. I refuse to chase FOMO at the top of a vertical candle. I've been in this market long enough to know that parabolic moves can reverse just as fast as they start. I'm not buying at the peak of euphoria. I'm waiting for a pullback, or I'm staying patient. But if spot silver dips to $75 and premiums remain at $20 or more per ounce, then I'm looking to rotate some of my holdings. Specifically, I'm considering selling some of my 90% junk silver to dealers and using that cash to acquire 100-ounce bars. Why? Because the premium structure on bars is lower than on coins, and I can effectively lower my cost basis per ounce while still holding the same amount of silver. It's a tactical move to get more efficient exposure. And if the Federal Reserve announces a surprise rate hike, if they try to pull the rug out from under this rally, I'm expecting a paper washout, a violent short-term crash in the futures market. But I'll be watching the physical dealers. If premiums stay high, if inventory stays tight, then I know the crash is just noise. And I'll be at my local coin shop, cash in hand, looking to add to my position while the market is panicking. Here's what drives all of this. This isn't about profit for me. It's about the exit. It's about getting out of a system that I no longer trust. The dollar is a promise backed by a government that's $40 trillion in debt. Silver is a metal that's been money for 5,000 years. When the system starts to crack, when the paper price and the physical price start to diverge, that's the signal that confidence is breaking. And I want to be on the other side of that break. I have my levels, I have my triggers. But here's the question I want you to ask yourself. Do you know what your exit looks like? Do you have a plan for what you'll do if this decoupling accelerates? Or are you just watching the ticker, hoping that someone will tell you when it's safe to move? Let me bring this together. The physical silver market has broken away from the COMEX. $100 American Silver Eagles are the reality for anyone who wants metal in their hand. The dollar has officially blinked. The so-called spot price is increasingly a fiction, a number on a screen that has no relationship to what it costs to actually own the asset. The screen is lying. The vaults are crying. And the system is trying to hold it together with margin hikes, media spin, and the hope that retail investors won't notice the gap between paper and reality. But I'm noticing, you're noticing. And the more people who wake up to this, the faster the exit door shrinks. Here's what I want you to watch next. The gold-silver ratio is collapsing. For most of the last decade, it's been hovering between 70-1 and 90-1, meaning it took 70 to 90 ounces of silver to buy 1 ounce of gold. Right now, with gold at 4,600 and silver at 85, we're sitting around 54-1, and it's falling fast. When that ratio breaks below 50-1, it's a signal that silver is catching up to gold as a monetary metal, that the industrial demand story is merging with the monetary demand story, and that we're entering a new phase. I've done a deep dive on the 50-1 ratio, on what it means historically, on where the floor is, and on what happens when silver starts to outperform gold on a percentage basis. That's the next piece of the puzzle. Because if you understand where the gold-silver ratio is headed, you'll understand exactly where this market is going in the next 3 to 6 months. Don't let the ticker tell you what your wealth is worth. The paper market is a ghost. The physical market is reality. And reality just hit $100 per ounce.